Hi everyone. For those of you who don't yet know me, my name's Jade Earley. I'm one of the directors here at Y Partners Wealth and Advisory. Collectively, we wanted to send a quick video out to all of our clients to let you know of a few of the topical things that we've been looking at over the last couple of weeks that we think might be of interest for you. So firstly, and I'm sure you may have seen some coverage of this on the news over recent days, but I wanted to touch on the collapse of the Silicon Valley Bank over in the US that's taken place over the last week or so. So just to give you a little bit more background around this particular bank, it was founded back in 1983 to provide funding for venture capital groups and also to tech startups operating out of Silicon Valley. So it had a very concentrated clientele type and lacked the diversification that you might see across deposit holders of other ordinary banks. So this has created a unique set of risks for that particular institution as opposed to the broader banking sector. And there now appears to have been a bit of a mismatch between the way that the bank was investing the capital that it has to set aside for deposit holders and the needs of those deposit holders in the event of withdrawals. A lot of their money was invested in mortgage-backed securities that are quite long dated. So these are quite low risk and fine if they're held through to maturity. But what we've seen over the recent weeks is a high need for withdrawals, which meant they had to cash in a lot of these investments early, leading to heavy losses. So on the back of these sustained withdrawals, we've seen the Silicon Valley Bank enter into receivership last week on the 10th of March and has now been taken over by the Federal Deposit Insurance Corporation, who are now in charge of overseeing operations. This has understandably shaken markets a bit, especially confidence in the banking sector. But thankfully, on the weekend, we've seen the US government come out and provide additional certainty for deposit holders, including those with over $250,000 in their balance, that they'll be able to fully access their accounts from Monday the 14th, which is today our time. The effect of this guarantee is yet to be seen, but it's likely to have reduced panic amongst the banking sector and will hopefully avoid a broader run on banks that we saw back in 2007 and 8 around the global financial crisis. It's also worth noting that following the global financial crisis and the Basel III requirements that followed, all banks are required to hold significant amounts of capital now to fund deposit holders' withdrawals, much more than they would have pre-GFC. So broadly speaking, the banking sector is in a pretty strong position, especially here domestically in Australia, where most of our lending will be for property or physical property, as opposed to, in this case, we've seen a very niche, specialised venture capital funding. From an investment perspective, we expect to see heightened volatility over the coming weeks as the market further digests recent events and the government response. And we've started to see bond yields fall with the expectation that the Federal Reserve may not be able to continue on the same aggressive interest rate rising trajectory that they've been on over the past 12 plus months. From our portfolio positioning, we're not looking to make any tactical changes arising from this particular issue, but we'll closely monitor the situation with our research partners, Mercer, and we'll let you know if this changes or if we do need to make any adjustments to your particular investments. Now on to other issues. We've had plenty of phone calls over the last few weeks in relation to the Treasurer Jim Chalmers' proposed tax changes to superannuation balances over $3 million. So under the current rules, which came into play on the 1st of July 2017, people can hold up to $1.6 million in a tax-free pension account, which has now been indexed up over time, with the remaining balance held in a superannuation accumulation account where it will pay 15% tax on the earnings. What the Treasurer has proposed is an additional 15% tax on the earnings component related to the balance over $3 million. So it would effectively make the tax rate on this portion of people's account balances 30% as opposed to 15% previously. So this is not a change that will impact everybody across the board, but it will have a potential impact on a cross-section of the community. At this stage, these are still proposals, so nothing is set in stone, but as more information comes to light, we'll be busy reviewing potential strategies we could implement with you to lessen the impact if this is possible, and we'll be sure to work through it in detail in relation to your particular situation with you. We also wanted to send out a quick reminder around potential strategies we could be looking at with you right now due to changes in the superannuation rules from July last year. So from July last year, there's now no work test requirement for people to contribute their after-tax money into superannuation. And this has opened up the door for us to help people move money from outside super into their superannuation accounts where the earnings may be taxed more concessionally than where it was. There are also a number of strategies we can look at now to help significantly reduce the tax your estate may pay one day on the receipt of money from your superannuation, which wouldn't have been available prior to these rule changes. If you'd like to know any more about these strategies, we're happy to discuss this with you at your next review and see how this fits in with your personal situation and whether there's any benefit we could help you achieve from it. And finally, we wanted to give you a quick update on how share markets have been performing this calendar year so far. The Australian All Odds and the UK FTSE 100 have been flat to slightly negative so far since January. And we've seen US and European markets up between 6 to 7%, which comes on the back of their heavy losses of last year. And we've also seen Chinese markets rebound strongly over the last few months as China starts to reopen to the world. Their markets are up about 5% since the start of January. Thanks a lot for your time today. As always, if you had any questions around anything that I've raised today, please feel free to give us a call on 8110 6400. We'll be more than happy to talk this through in relation to your particular situation. And we look forward to catching up with you again at your next review. Bye for now.